20% earlier today as the Reddit rebellion on Wall Street continues. MKM Partners downgrading the stock to sell and giving it, get this, a $1 price target, saying that liquidity is definitely not an issue for the stock, but the solvency could come at a steep price. Here now to explain is the analyst behind the call, Eric Hander. Eric, thank you for being with us today. A $1 price target. I mean, shares of AMC, and I realize they've lost some steam in afternoon trading, but they're still about $14 a share. So what are we talking about here that gets you back down to $1?
Well, I think you got it right in the sense, the Reddit frenzy, the Wall Street bets has done a great job of creating a huge short squeeze on the shares, but that's not a sustainable long-term strategy. When you look at what's happened with the company, in order to survive and create liquidity for itself, it has issued, the number of shares outstanding has quadrupled, essentially diluting equity shareholders by 75%. Meanwhile, debt remains at a very high level, $5.7 billion. They've got another $450 million of deferred rents that will have to be addressed at some point. So the stock move really has nothing to do with fundamentals. It's all about emotion and a short squeeze.
Yeah, I am curious, so just to dig into that a little bit more, because I think it's a key point, not only for AMC, by the way, but for some of the other hard-hit names in hard-hit industries by the pandemic, whether it's airlines or some of the other retail names, et cetera. It's the fact that you have seen these companies take on more debt, issue more stock to raise capital to weather the storm. And it, I think, raises the question longer term about what that path forward is going to look like when we return to, dare I call it, a pre-pandemic normal.
When I look at AMC, obviously they have been severely impacted by the fact that there's been no movies released during the COVID pandemic, and movie theaters are operating in a zero revenue environment for the most part. There's been times where theaters open, but there's no real new blockbuster content that's coming out, and that's hurt them. And as a result, companies like, AMC, they're burning about $120 million of cash a month. And they have done a good job of raising fresh capital. But, like I said in my report, I think that the cost of that liquidity comes at a severe price. You have severe equity dilution and a balance sheet that has a very large amount of debt.
So do you think we're going to see, I guess, more deal-making, consolidation, mergers, whether it's AMC or others in the movie theater space, in light of this?
Well, what I think is going to happen is, I do think in the back half of the year, we will see the exhibition industry get back on track, and we're going to start seeing blockbuster films, assuming that, positivity rates come down, vaccinations happen, and we get close to herd immunity. We'll get back to a somewhat normalized environment. I do think the industry will get there in 2022. We'll see a slow and steady ramp in 2021, but I think that companies, rather than looking at consolidation or acquisitions, they're going to want to shore up their balance sheets, start getting to be cash flow positive, and start the deleveraging process. I think that's the first, second, and third priorities for all of these exhibition related companies.
So Eric, I guess the final question is, can this company last long enough to get to that 2022 turn of the curve, or are you saying high debt, zero revenue, and moving maybe a little bit higher, that this is a Chapter 11 situation, or a situation where somebody comes in, to reference back to Morgan's question, and consolidates, buys it? Would a Disney buy it? Would a private equity company buy it?
Well, I don't see any of the major media companies wanting to own movie theaters. Private equity, that's always an option. And there's obviously a lot of private equity money on the sidelines. For AMC, look, I do think they have enough cash on hand to get to the end of the pandemic. But look, they're going to reach a point where they have to pay a mountain of interest expense every quarter. Their cash flow, their free cash flow hasn't been enough to really pay down a lot of the debt. So they're still going to be operating in a very tight environment once we get into the post-pandemic environment.
Shepard Smith here. Thanks for watching CNBC on YouTube.